Good morning, traders. It is 8:02 a.m. Chicago time on Monday, the 12th of June, 2023. This is episode number 2481. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, I'm having some difficulties uh, with the with IRT right now, which feeds the pre-market summary sheet. So I'm using the static one from the from Twitter, and it gives us the same idea, except it was posted about 15 minutes ago or so. The market's showing a risk-on sentiment this morning. No real news flow other than, in general, there's this idea that the market has moved about 20% from its bottom, and there's just the kind of a mainstream media narrative of there's a new bull, and it's kind of obligating many to deploy funds into the markets right now. Um, but what's on deck this week is very, very major. So I'm actually kind of surprised that they're pushing higher, in that we have a lot that's ahead of us. Technically, the picture is very clear. We were in balance for a long time, and we broke balance to the upside. And so the expectation is, since we're not giving up the highs and we're broken out of balance, we are likely to continue to push higher on the indices, and that's what we're doing. The NASDAQ's leading the bunch by being up 53 basis points this morning. The NASDAQ led out of balance a few weeks ago anyway. Tomorrow we have CPI, and then we have the rate decision on Wednesday. We have the ECB on Thursday. We have the Bank of Japan on Thursday night. And then we have Triple Witching Friday this Friday. Really important for you to note that that we have rolled. I'm going to show you the roll factors. They were posted by Convergent Trading. Let me bring this over here. Here are the roll factors. This is information that that you can use to determine what the price difference is between the June contract and the September contract as attributed to the roll. I'm not going to get too deep into this. It's quite technical about what futures are and how they work, but essentially, as of this day today, actually, as of the close of Friday, we had a settlement. Here's the official settlement. On Friday, the S&P June contract settled at 43.0475. For those of you who can't see it, there it is, nice and bright, nice and big for you, 43.05. The September contract settled at 43.4875. The difference between them is 44 points. So what you have is, once you go to Monday, which is Monday today, is the official rollover day for the U.S. indices. That means today you should be trading ESU3, NQU3, RTYU3, YMU3, EMDU3. Okay, you should be trading the September contract. You should no longer be trading the June contract. The volume will be fine. You should be rolling forward to September. As soon as you roll forward to September, the cost of carry as of last Friday between the contract that's expiring this Friday, which is June, and the contract that is expiring 3 months from now plus a week, which is in September, the third Friday of September, the contract difference, the price difference between them is 44 points. And if your charts do not adjust the June expiration to June, the M3, H3, which is March 3, Z2, which is December 2022, U2, which is September 2022, and on and on and on backwards. If it does not adjust those old contracts up by 44 points, what you end up with is a gap. And that gap never happened. And that gap is going to interfere with the validity um, of your moving long-term moving averages and things like that. And so you end up with a chart that is actually not representing the truth. And so just make sure you understand this so you can attend to it, so to speak. There are products that just don't do it right. I know TradingView doesn't do it right. TradingView has an artificial gap as of last Thursday. That first of all, we have not rolled the Thursday before expiration in about 2 years. In addition to that, um, we we eliminate that gap by back adjusting prices. So you'll see on non-back adjusted charts on those pieces of software that don't back adjust properly, you will see a fake gap every time the market rolls. And just be aware that this is the situation. This is a situation because what it does is it takes your anchored VWAP and knocks it way out, takes your moving averages that go across days, knocks it out. It knocks out. It introduces a fake gap into your charts, into your profiles, and things like that. Just be aware. Okay. So back to business. Let's talk about what's happening here today. So that's what we have. We have triple witching Friday. Friday, this is rollover week. The pace of the roll is really lagging currently, which is really interesting. The roll is should be about 70-ish% done usually, something like that, and it's been very kind of muted. I track the pace of the roll because I know that from the time we start rolling until the roll is done, I know that the volume and specifically the delta, so your order flow tools are likely to be off because a lot of the lifting and the hitting that's going on in the market, in other words, aggressor volume during this period, is likely to be influenced quite heavily um, by the fact that there's people who are having to roll. Here's the pace of the roll. Look at the pace of the roll here. The current pace of the roll is 27.66%. 27.6% on the ES when the average is 54.68 with 4 days to expiration. We are about half rolled, and if you also recall, and if you follow on Twitter, I posted those shots showing new all-time highs in the micro ES open interest, and now that open interest isn't rolling very efficiently. I mean, on the light side, we should be at 52% done. On the heavy side, we should be at about 57% down. On the average, we should be 54% down. We're 27.66%, which most likely means that instead of going back to normal on Wednesdays as we do, it means that we are likely to see roll effects into Friday, which really kind of stinks because it prolongs the roll. And that's the net effect of that. I know this stuff is technical. I might have lost you in it, but it's important. These are important considerations. Looking at what's ahead, there's really not much today. Consumer inflation expectations out of the U.S. for May at 11 o'clock. And then we have a $40 billion 3-year note, and we have a tens auction at 1. This is important, $32 billion, lots of liquidity being created here, and in a monthly budget at 2 p.m. The S&P has traded somewhere around 138,000 contracts, which is kind of light compared to prior sessions at this time of day. The inventory is 100% long. The market's really pushing higher, has not traded below Friday's settlement at all. and the range is 18.25 points, which is pretty decent. Okay, point of control shifted to 43.54. The market's progressing higher pretty well. Here's what the TPO chart for the S&P looks like. We, to bring things into context, here's the balance that we were in for a couple months. We broke higher, and then we are consolidating. And what we've done is we've kind of we've created this small downward sloping channel, and what we have is a kind of a flag continuation play, which was what was expected on Friday. If you watched the Trader Bite on Friday, this is what was expected, but we were looking for it to stall in the old contract of 43.16. In the new contract is 43.60, and it went to 69. We expected it to stall at 43.16, which is the equivalent of 43.60 in the September contract. This is U3 here, ESU3, just to be sure that those following understand why my prices are different than yours. It stalled out just about 7 or 8 points above our target and came back in. And what we had on Friday is the market finishing actually just a tidge below the open, right at the high, right up against the 43.50 in the new contract. So Friday's push was relatively weak. The overnight session has a high of 67 against the 69 quarter high. So we have an inside day in the overnight session. Let's go and look at what the overnight session has done. There it is. Friday was quite interesting. It like one or two ticked. I think it's one tick. It had a one tick fail auction back to the mid and VWAP, which actually set up a pretty decent long for a continuation. The market showed that it was relatively strong on Friday, stayed ahead of VWAP and mid, finally tested mid, gave one scale out, and then fell below the mid and then slushed its way through. To me, it started to look like it was likely to bounce out, but I was completely wrong there because we ended up with a pretty good, once we failed at the high, we ended up with a pretty good impulse down. It pushed through our day generated levels back towards the prior higher day. We had a gap zone on Friday, and it ended up closing it right here. We ended up pushing to settlement on Friday, consolidating and then holding sideways for balance for the rest of the session. Friday looked like it was bullish, but actually it became relatively muted. The buyers got their work done early, and the selling we saw in sweeps, right? So if you watch the action on Friday, you would have noticed that there were quite a few flushes on that sell-off. In fact, that this impulse down here looked like news to me. Didn't see anything special going on, but this was quite aggressive. There was quite a bit of negative delta on that push down. It doesn't matter. The fact is we have an impulse down, which tells us we need to lock and load and be ready for action because we're looking now for the continuation. We're looking for it to close the gap and it becomes a gap to settle. Once I see that the impulse has taken place, the only play I have is a gap to settle trade, right? So now all the decision making gets distilled down to where can I get in, where I can minimize risk, or I can define risk in such a way that the risk stop that I'm going to use is going to be hard for the market to get, but not so far away that my target has to be really, really far to offset the risk. So this is the tricky part. This is the hard part that people generally struggle with. In fact, I think people struggle with the process well ahead of that. People struggle with the process of, I see a lot of discussion on Convergence chat room. It's kind of like a Discord. And it seems a lot of it's around what should I do now? You know, there's this question, what should I be doing? What should I be looking at? And to me, it's Newton's laws of motion, kind of like the market. Just you want to go with whatever direction the market moves in until a new force comes in and reverses or changes that direction. That's kind of the principle I go by. I'm a scientist. I'm an engineer by practice. So I tend to put things in those terms. You may not be, but in general, you know, when I see something, when I see the market kind of rotating bigger, making bigger positive rotations than counter rotations, I'm going to lean on a long bias, and it just becomes about, okay, what is this trying to do, and how good of a job is it doing, and where can I get in with defined risk reward to be able to take advantage of it. And when you have an impulse, what that's doing is it's blowing through. It's essentially telling you, no, there's a much, much bigger force in play. So impulses are really important, and the impulses are delineated by these lines right here. An upward impulse, a positive impulse right now, statistically speaking, is 7.75 points. A downward impulse is 8 points. Anything that exceeds those, I'm going to look for a continuation. So every time you see these things cross these lines, the expectation is for another continuation unless that top is taken out, in which case the impulse is invalidated. It's a lot more detail than I wanted to get into this morning, but what we have in the overnight session is a Gaussian or balanced profile. We've tested the high pretty good. We've pushed. We had a continuation trade. We've impulsed the other way. We didn't quite have a continuation of the impulse in the other direction, and then sideways action since. So it's kind of it's just balancing out. It's balancing out on top the above the prior settle, inside of Friday's range, above Friday's value area. It has a positive skew to it this morning, so just be aware of that. Looking at the NASDAQ, same story, just trading inside of Friday's range. NASDAQ multi-distribution, pretty actively holding the full session VWAP here, pretty positive. Overall, the NASDAQ's also 100% long this morning with settlement 14,735.75. And we're holding in the upper distribution of Friday. Today is another one of those days where I'm just going to wait to see what happens. You know, is it going to hold a lower high and start pushing lower, or is it going to open, break the lower high, and start pushing up towards the upper distribution of the NASDAQ, in which case then I'll start looking for the 14,860 and Friday's high. The anticipated response today is expected to be, I'm anticipating it being an inside day to Friday and holding steady for CPI is what I'm looking for as a primary scenario, but I could be wrong. The better trades, of course, it gives up the 14,680 and then starts moving lower, would be the quicker, faster, kind of more profitable trade, in my opinion. If not, then we just continue to grind higher, and you just have to watch your rotations. Again, be careful with order flow today. The roll is in full effect. Today, we should be trading the September contract and roll week. I could tell you that roll week statistically, I've been trading for 23 years. 2 of those started with equity trading, and 21 of those are in futures. And I could tell you that it is rare that I have a good week trading roll week or expiration week. So I'm very, very defensive, cut size, you know, pick your spots kind of trading. We do have the FOMC this week, so it's kind of special. But overall, I'd ask you to be conservative with your expectations and just kind of stick to your A+ setups for this week, and be patient as the market has to make some big decisions over the next 2-3 days. Okay, so just keep that in mind. That's all I have. I don't have any clear scenarios or anything. We looked at the TPO chart. Not much there to talk about. quite balanced. Looking at the NQ, same thing. The NQ, trying to push higher, and it's just kind of stuck in a range. The NQ got ahead of itself. The crude, however, crude has really has had really impressive moves. Crude has pushed through a lot of the support that I had designated. So this line here, this zone here was support, now resistance. I had to change the color of it, and it just gets these little bounces at my support areas and then continues right through. It's been quite a forceful move down in crude. I mean, pretty aggressive, pretty violent last week. And crude continues to try to want to challenge that 67 down below and into the spike zone. Hard to say what it wants to do here because there's a lot of crosswinds going on in the energy sector. The recovery isn't what it was supposed to be for China. The demand on commodities isn't what it was expected to be. And so crude is taking a bit of a beating here, and then to the point that that OPEC is interceding. The Russell moved back to its balance. We talked about this last week when it was down here. I said, hey, this thing is likely to push towards the most recent balance, and that's right there. It kind of got to balance, and it's been petering out. It's pulling back. The Russell has broken out of a very, very big balance zone to the upside, and it's now kind of drifting lower. Same story as everybody else. It's likely to be a drift on a week where things are likely to be to change. Does the Fed actually raise rates again 25 basis points, or will it go with what the Fed fund rate futures are pricing in, which is about a 75% probability of a pause? What does it do when it comes out on Wednesday? What does inflation look like on Tuesday? We know that employment's been hot, so that's been putting pressure on the Fed. We'll see what happens. It's kind of an interesting play this week. Mind your risk. That's all you can do. And then I'll catch you tomorrow morning. Take care.